Hey everybody, it's Boris Schlossberg. I am coming to you from the West Coast this week. That's why I'm kind of talking a little bit quietly because everybody is still sleeping here. So forgive me for the bad video, perhaps the bad sound, but I hope you guys really enjoy the week ahead because we have so much action this week that is just mind-boggling. Of course, the Murphy's rule of law is the moment you go on a vacation, all hell breaks loose. War certainly was the big theme this week, and it just had a tremendous impact on every single asset class that we follow. But let's start with the one that we talked about last week that had the greatest impact, which was gold. We were very bullish gold, obviously, into the start of the week because it looked tremendously strong on the charts. And gold was essentially signaling that risk off is going to be the theme this week. However, what's really interesting as we close out this week now is looking at the fact that gold effectively has done a massive flame out. If you look at the chart here, as I posted here, gold has become the perfect proxy for the kind of a roller coaster markets that we've had because of the Ukraine crisis. But given how fluid the situation is in today's markets, you really cannot trust the chart itself, meaning right now it looks very much like a flame out, and basically gold set its near-term highs. We talked about the idea that it was going to go to 1950. It hit 1950 and then retreated back off those highs. The big thing I think now is to see how well we're acting around the 1850 level. The midpoint for the month is about 1886, which is where we're kind of consolidating right now. And certainly gold is acting like it's in a wait-and-see mode for the time being. Now, next week, we have some hopefully positive geopolitical news. There seems to be at least the prospect of diplomatic talks between Ukraine and Russia in Minsk. Perhaps that will lead to a ceasefire and stop this destruction, and that would be very, very positive, of course, for the world and for the markets. And that maybe is what gold is sort of pausing on. However, given how fluid the situation is, given how this is really all being driven by geopolitical risks, I think you essentially can't trust the chart at this point for anything but the next 30 minutes forward. Things can change if the situation gets very ugly, if they continue to persist in aggression. I think you're going to see even greater problems here because the conflict will escalate both politically and economically, meaning that if Russia, I think, persists with its conflict, you're going to have more and more economic sanctions. That in turn is going to create even greater fears of a big inflationary spike in the world because Russia is such a massive, massive producer of a lot of commodities. And the thing that everybody discovered this week, of course, is that Ukraine is the breadbasket of the world. It produces 25% of the global wheat market. So any sort of supply disruptions that we're seeing here on the economic front are going to definitely translate themselves into massive inflationary pressures. And that in turn is going to create perhaps a secondary rally in gold. For now, as we look at the charts, clearly the price right above the 2000, which was the peak that we saw in the pandemic highs, is where it failed at this point. If things begin to ease, if we see greater diplomatic progress, gold could easily fade right back towards the 1850, 1800. At that point, you then have to just sort of say, is there a long-term support for the trade? But it becomes a completely different trade from what we're seeing now, which is just clearly a big geopolitical spike and reaction trade. As we stand here, to me, the midpoint to the month, which is about 1880, is where you want to be looking at as a potential support area. How we trade here is going to tell us if we decline further towards the 1800s, or if we have a chance to perhaps resume for the fresh highs. But it is very much a headline-driven trade, and that's what we're going to be watching as we go forward. Oil, very much similar, but in fact, oil I think is in many ways even a greater replication of this whole roller coaster ride trade that we're seeing. I mean, in fact, I think if you wanted to be smarmy about it, if you wanted to just be callous about it, you could say that really the Putin trade at this point is long gold, long oil. And the worse the situation in Ukraine becomes, these two assets are certainly going to respond strongly. The better we have in terms of diplomatic action and a ceasefire situation, all of these assets are going to see some very serious sell-offs. There was very, very many analysts that I had on my trading battle, by the way, who made terrific points about the fact that oil is grossly overbought at these levels, that the producers were actually selling rather than buying at these levels. And you could see that there was this massive geopolitical spike that just came down very hard. The fact that this has come down so hard off the highs suggests that there's enormous amount of supply here at this 100 level. And unless we seriously enter into a quasi Cold War status here at this point, it doesn't look like gold. As a matter of fact, it looks like gold is really going to be a strong sell. One of the interesting things I like to look at technically is the fact that we've given up the midpoint mark. One of the great trades I love to do is when we go up to the highs and give up the midpoint mark. This is the monthly midpoint mark. That suggests that there's further weakness. We could even drift all the way down towards the 90s and 89s. But again, very much a geopolitical trade. So you have to take the chart with a grain of salt. If the news continues to be positive on the diplomatic front, this certainly looks like a further sell as we go into next week. Bitcoin, which was a super interesting trade this week because it was certainly for those who thought Bitcoin was going to be a harbor of safety, certainly we're given a very, very rude awakening this week because Bitcoin effectively is a risk asset. And as soon as risk-off trades came in due to the war news, Bitcoin sold off incredibly hard all the way down to the 3,400. We were in negative Bitcoin. We came in last week saying it's one of the worst looking charts. We think it goes down further if there's more friction. And indeed, that's exactly what happened. However, what's interesting now is that the bounce in Bitcoin has been extremely strong. And I think especially the price action that you saw on was it? It was Thursday. It was on Thursday. I forget where I'm at here. On Thursday, that had this massive, massive comeback. Sort of you had this huge 3,600 to 40,000, like almost a 4,000 point move here in a matter of hours, is a very, very strong indication that some massive bids came in. Now, I was obviously being facetious here saying it's the oligarchs, but it's not a ridiculous theory to think that given all the sanctions against all the major Russian oligarch players, many of them may have decided to shift huge amount of their fiat assets into Bitcoin simply as just a fear trade on their part. In other words, if they wanted to protect whatever assets they had, regardless of price, into an asset that could be a store of value away from the control of the U.S. Maybe that happened, maybe they didn't, but it's certainly really the kind of price action that we saw here on Thursday certainly indicates that there was a big whale buyer here that couldn't care less about price and just drove everything up higher. And that in turn, I think, is relatively positive for crypto at this point, and you have to respect the chart. The next positive move here is the break and hold above the 40, which is the midpoint mark. If we can hold and do that into next week, that would suggest, first of all, perhaps there'll be an easing of risk flows, which is obviously going to be positive for Bitcoin. But more importantly, that could suggest maybe that there is a large-scale movement into the asset, essentially for its original purpose, which is a safe haven, safe harbor asset. So this should be a very interesting trade to me. We should be watching that next week. And as I said, if we can hold it above the 40,000, which is the midpoint mark, even more bullish news for possible continuation as we go forward. Next is indices. Now, indices with NASDAQ. Where's my NASDAQ here? I'm having a hard time pulling up my NASDAQ here for some reason. Oh, here's the NASDAQ. Sorry. So the next thing that I think is interesting is I said, NASDAQ shows a very similar V-shaped type of bottoming pattern, and it was the best indice of all the stocks. It recovered the fastest. And I think obviously it's because technology companies are, in a way, in some ways, least affected by the commodity stress that you're going to see on other assets that are more industrial. And that, of course, is positive. These are simply pure risk on, risk off assets. And they are responding positively to any kind of diplomatic movement. Again, this is a very, very day by day, minute by minute type of a trade. So you can't really trust the charts too much. But I think if you have this double combination, which is sort of very interesting, positive news, which we came out with relatively strong economic news, and positive development on the diplomatic front, you have a golden combination for for NASDAQ. And this kind of a inverted head and shoulders, sort of a very, very big V-shaped bounce, super positive. Here again, we have to be looking at the midpoint mark here at around the 14,200 level or so. Can we recapture that into next week? If we can, then we have relatively calm diplomatic news in the background, that should actually be super positive. Because one of the things that I think is happening, the reason why NASDAQ is responding so well to all of this is previously the assumption was the Fed is going to become super hawkish on its rate front in order to contain inflation. However, now with the prospect of geopolitical tensions going on, the Fed naturally goes into a much more dovish mode, and the chance of rate hike of 50 basis points versus a 25 basis point rate hike has gone down radically. I think down to 12% versus something like 80% before the Ukraine conflict. So if there is a rate hike, the market is looking at it as a smaller rate hike. Any kind of a smaller rate hike is very positive for NASDAQ, which operates on cheap money. So the cheaper the money, the better it is for NASDAQ stocks. That's why this is acting as such a positive positive price action as we're looking into next week. So if you get this combination of a more dovish Fed, Powell testifies next week, so we're going to watch that very carefully, strong economic data, and a positive movement, perhaps even the best case scenario, some kind of a ceasefire and a cessation of aggression in Ukraine, you could have this perfect combination of breakout moves, especially if we can take out the 14,200, and that creates, I think, a further fuel for NASDAQ as the better trade into next week. And then last but certainly not least is FX. And FX is really got its own story next week because, as I said, against the Ukraine backdrop, FX is a very, very big risk event calendar next week. We have the RBA, we have the BOC. Then on Thursday, we have the US ISM services, which is the single best predictor of non-farm payrolls that we have on the books. And then, of course, on Friday, we have the non-farm payrolls. Now, what's interesting is that against this whole background of very, very tense geopolitical news, the economic data has really shown a very strong rebound. Today's data, for example, on Friday, as I'm recording this, has shown that U.S. durable goods and U.S. spending has been very healthy, even when you embed inflation into it. It rose on a 1.5% real basis. That's a strong rebound by the U.S. consumer. And I think that's really the story. The U.S. economy is just operating on all cylinders at this point, despite the inflationary pressures. Demand is very strong. Supply is trying to keep up with demand. And that kind of growth seems to be very positive for risk assets, and in turn should be positive for risk currencies, which certainly saw a huge sell-off. Euro just got decimated on this risk-off, everybody wanting dollars trade. However, if we are able to see a relatively strong U.S. performance into the end of the week, I think it actually would be good for Euro and pound, not because their economies are going to be much better than U.S. economies, because the market is going to just breathe a sigh of relief on a risk-on flows. Overall, though, as we're looking at FX right now, of course, this 111 is the spike low in the euro. When we look at Dali Yen, the moves were also, very, very spiky. This 128.20. Dali Yen is already acting very, very well in a sense that it's breaking the midpoint level here. And the whole idea here is basically that I think Canada, in many ways, is a silent beneficiary of all of these moves. Because remember, Canada is a massive producer of a variety of commodities, including, by the way, even wheat and other things that are going to be contained in Ukraine. And that should all really flow very well towards the Canadian economy. In many ways, you could say that, the Canadian economy, along with this Wednesday's Bank of Canada rate decision, which will be very interesting to see, because assume the following situation. You have a Bank of Canada rate decision where the Bank of Canada is relatively hawkish. They sort of shrug off the Ukraine conflict and say, we feel the economy is strong enough now for a sustained rate hike. So you have this tight monetary policy regime, demand for all of their assets globally now that Ukraine is out of the equation for a while. and Russia is essentially embargoed, and all of that provides very strong move for the Canadian dollar, and perhaps creates, certainly on the charts, we're starting to see a very nice move to the downside, which means we could see 126, 126.50 as the week progresses, on essentially positive flows into what is effectively the one great commodity producer that is outside of any political risk at this point. And then finally, looking at the Aussie, which also is recovering nicely here on a risk move. That's going to be a question, I think, of interest for us as far as what does the RBA. RBA has been relatively dovish in its stance. It'll be interesting to see how they interpret all the situation now with the Ukraine situation, with the tensions in China still going on, with the lifting of many of the COVID restrictions in the economy. It'll be interesting to see. At this point, the 73 seems to be a very strong resistance in the Aussie. And even if there's a positive burst post RBA, probably that will be the cap for the move. And finally, Dali Yen, which is, of course, the proxy for risk and risk off assets. What's interesting here is, by the way, notice that it really did not collapse nearly as badly as you would have thought, given the massive risk off flows we had earlier in the week. It held the 1400, trading nicely above the midpoint mark, and positive U.S. news combined with positive diplomatic movement on the front should be very, very good for Dali Yen. We could see Dali Yen move to the 116 handle on any kind of a beat on the NFPs, which is very feasible given the very, very strong weekly unemployment claims that we've seen this whole week. So that's sort of how the week shapes up here. I think if you pull back, Nasdaq, Dali Yen, Bitcoin all seem to be big beneficiaries of any kind of a relief risk rally as we go forward. On the other hand, oil and gold, if things improve into next week, certainly look better sells than buys. If they don't, if tensions become even worse and we perhaps have even greater military aggression, a lot of these scenarios turn themselves around, and you certainly have to go back into oil and gold as the primary, what I would call war trades into the week. But we'll see how it shapes up. It's definitely going to be a very, very interesting week, just as this one was. I wish you guys the best of luck, the best of trading, and I'll see you next week. Boris Schlossberg, over and out.